Good morning, gentlemen. My name is Jay Parker. I'm from Washington State. And this question regards mistakes. So that being the case, it should probably be directed to Mr. Munger. Mr. Munger, I know you're fond of evoking humility to promote rational thought. So my question is, what's the most recent business mistake that you've made, Mr. Munger, and why did it occur?
I'm going to take notes on this one.
The mistakes that have been most extreme in Berkshire's history are mistakes of omission. They don't show up in our figures. They show up in opportunity costs. In other words, we have opportunities. We almost do it. In retrospect, we can tell that we were very much mistaken not to do it. In terms of the shareholders, those are the ones in our history that have really cost the most. And very few managements do much thinking or talking about opportunity costs. But Warren, we have blown
billions and billions and billions. I might as well say it.
Right, right. And we keep doing it.
Some might say we're getting better at it.
I don't like mentioning the specific companies because we may in due course want to buy, do so at our price. But practically everywhere in life and in corporate life too, what really costs in comparison with what easily might have been are the blown opportunities. I mean, it's an awesome amount of money. When I was somewhat younger, I was offered 300 shares of Belridge Oil. An idiot could have told there was no possibility of losing money and a large possibility of making money. I bought it. The guy called me back 3 days later and offered me 1,500 more shares. But this time I had to sell something to buy the damn Belridge Oil. That mistake, if you traced it through, has cost me $200 million. And it was all because I had to go to a slight inconvenience and sell something. Berkshire does that kind of thing too. We never get over it.
Yeah. I might add that when we speak of errors of omission, of which we've had plenty, and some very big ones, we don't mean not buying some stock where a friend runs it or we know the name and it went from 1 to 100. That doesn't mean anything. We only regard errors as being things that are within our circle of competence. So if somebody knows how to make money in cocoa beans, or they know how to make money in a software company or anything, and we miss that, that is not an error as far as we're concerned. What's an error is when it's something we understand and we stand there and stare at it and we don't do anything. Or worse yet, what really gets me is when we do something very small with it. We do an eyedropper's worth of it when we could do it very big. Charlie refers to that elegantly when I do that sort of thing as when I'm sucking my thumb. And they're really, I mean, we have been thumb suckers at times with businesses that we understood well. And it may have been because we started buying and the price moved up a little, and we waited around hoping we would get more at the price we originally started. There can be a lot of things, but those are huge mistakes. Conventional accounting, of course, does not pick those up at all, but they're in our scorebook. Zone 6, please.
My name is Joseph LaPrey. I am from Minneapolis, Minnesota. In recent years, tobacco companies have been compelled to pay large damages for marketing their unhealthy but discretionary products. My question has two parts. First, does the potential for similar damage liabilities reduce the intrinsic value of Coca-Cola, See's Candies, Dairy Queen, or any other business which sells discretionary products of questionable healthfulness? Not that I don't like these products. And second, are either of you concerned that a possible erosion in the principle of caveat emptor is undermining the legal basis of contracts in general? Thank you for taking my question.
Well, the products you described, I've been living on for 70 years, so they'll probably haul me in as a witness if that they don't do much damage. No, I think if you're opposed to sugar, and I think the average human being eats something like 550 pounds dry weight of food a year, and I think 125 pounds or thereabouts. I'd have to look at it. It consists of sugar in one form or another. I mean, it's in practically every product that you have, and it happens to be in Coca-Cola, it happens to be in See's Candy, but it's in practically everything it's over 20% of what Americans are consuming one way or another. And the average lifespan of Americans keeps going up. So I would not be worried at all about product liability in connection with those companies. But product liability generally is an area that is a fertile field for the plaintiffs' bar, and we are conscious in buying into businesses, and we have passed up some businesses because we were worried about the product liability potential. Unless there is some legislative solution, I think you will see more and more of the GDP going into liability awards, and whether there will be any change by legislation, I don't know. But it's a big field, and the lottery ticket aspect of it is so attractive, because if an attorney can gamble a modest amount of time or even a reasonable amount of time and have a potential payoff of 10 or 20 or maybe in some cases hundreds of millions of dollars, that's a decent lottery ticket. Who knows what 12 people are going to be on the jury? As one of my friends who's a lawyer said, he said Lincoln said you can fool all of the people some of the time and all of the some of the people all the time and all of the people some of the time, but not all of them all the time. He says, I'm just looking for 12 that you can fool all of the time. All you have to do is get an award, and the odds are fairly favorable in a nation where lots of zeros have sort of lost meaning to people. So it's a very real concern in any business we get into in terms of trying to evaluate product liability. Charlie?
What's particularly pernicious is the increasing political power of the plaintiff's contingency fee bar. If you're on a state Supreme Court, in most places you're on for life. If you you're on for life if you want to stay for life. And the one thing that could get you off the court would be to really irritate some important group. And I think that greatly helps a lot of abusive conduct in the courts. I think the judges of the country haven't been nearly as tough as they should be on junk science, junk economic testimony, trashy lawyers. And I don't see and I don't see many signs that it's getting better. In Texas, they actually improved the Supreme Court of Texas, which really needed it. So there are occasional glimmers of light.
We make our decisions in insurance and in buying businesses with a very pessimistic attitude toward the chances of that particular ill that Charlie described being even moderated. I mean, we think we would project out that the trend would accelerate, but that's just our natural way of building in a margin of safety in decisions. Don't worry about eating the See's Candy or the Dairy Queen or the Coke. if you read the papers long enough, I use a lot of salt, and I was always being warned about that. And then, a few years ago they started saying, you can't get enough salt and all that. I don't know what the answer is, but I feel terrific. Zone 7.
Good morning. I'm Martin Wiegand from Chevy Chase, Maryland.
Good to have you here, Martin.
Thank you. Thank you for the wonderful shareholder weekend, and thank you for the leadership and education you give your shareholders and the general public. My question. Large airlines are in the news negotiating labor contracts. They claim they can't pass along rising labor costs to their customers. In the annual report, you say Executive Jet is growing fast and doing great. Executive Jet seems to be able to pass along its rising labor costs to its customers. Is this because Executive Jet has a rational compensation plan that keeps employee salaries in line with billable services? If not, why does Executive Jet do well while the airlines experience troubles?
Well, the big problem with the airlines is not so much what their aggregate payments will be. The real problem is when you're in the airline business and your wage rates are out of line with your competitors. When you get right down to it, the figure to look at with an airline, among a lot of other things, but you start with the cost per available seat mile, and then you work that through based on the capacity utilization to get to the revenue per, or the cost per occupied seat mile. And you could have labor costs or any other cost. You certainly have fuel costs up dramatically for the airlines from a couple of years ago. As long as you're more efficient than your competitor and your costs are not higher than your competitor, people will continue to fly. It's when you get your costs out of line with your competitor, which was the situation where Charlie and I were directors of US Air a few years back, and our costs per seat mile were far higher than competitors, and that was fine where we didn't have competitors on many of the short routes in the east. But as the Southwest Airlines would move into our territory, and they had costs, we'll say, and this is from memory, but they might have had costs of below 8 cents a seat mile, and our cost might have been 12 cents a seat mile. That is, you're going to get killed eventually. They may not get to this route this year, but they'll get there next year or the year after. So if you're running a big airline, a Delta or United or whatever, if your costs are on parity or less labor costs than your other major competitors, that is much more important to you than the absolute level. And the NetJet's service is not really designed to be competitive with the United Airlines or an American or something of that sort. It has a different group of competitors, and I think we have a absolutely terrific pilot force there, and we want them to be happy. But there's a lot of other ways. I mean, you want to pay them fairly, but with our pilots, for example, it's extremely important to them in many cases to be able to live where they want to and to work the kind of shifts that we can offer. So we attract them in many other ways than bidding against United Airlines or American Airlines. Big thing, and you can't take labor costs that are materially higher than your competitor in a business that has commodity-like characteristics such as airline seats. You just can't do it over time, and you can get away with it for a while, but sooner or later the nature of a capitalist society is that the guy with the lower costs comes in and kills you. Charlie?
The airline unions are really tough, and it's interesting to see a group of people that are paid as well as airline pilots with such a brutally tough union structure. And that really makes it hard in a commodity style business, and no individual airline can take a long shutdown without having considerable effects on habit patterns and future prospects. It's just a very tough business, by its nature. Passenger rail travel, even in a previous era, was a pretty tough way to make a buck. And nothing is all that different with the airline travel. We hope that our services are preferred by customers more than one airline seat is preferred compared to another.
You know, fractional ownership is not a commodity business. I mean, the people care enormously about service and the assurance of safety. And I don't think that, I don't think if you were buying a parachute, you'd want to necessarily take the low bid. Now, with the big commercial airlines with millions and millions of passengers, people, I think, probably correctly assume that there's quite a similarity in both service and safety. But if you're in a business that cannot take a long strike, you're basically playing a game of chicken, with your labor unions, because they're going to lose their jobs too if you close down. So you're playing a game of chicken periodically, and it has a lot. There's a lot of games, there's a lot of game theory that gets involved. To some extent, the weaker you are, the better your bargaining position is, because if you're extremely weak, even a very short strike will put you out of business, and the people who are on the other side of the negotiating table understand that. Whereas if you have a fair amount of strength, they can push you harder. But it is no fun being in a business where you cannot take a strike. We faced that one time back in the early 80s when we were in kind of a death struggle in Buffalo with the Courier Express. And when I bought the Buffalo News, actually Charlie did, he was stranded there during a snowstorm and he got bored. So he called me and said, "What should I do?" I said, "Well, you might as well buy the paper." And so we were in this struggle. But when we bought the Buffalo News, we had two questions of the management, and one of them I can't tell you. But the second one was, we wanted to meet with the key union leaders, and we wanted to tell them, look, if you ever strike us for any significant length of time, we're out of business. You can make our investment valueless. So we really want to look you in the eye and see what kind of people you are before we write this check. And we felt quite good about the people, and they were good people. And we had one situation in 1981 or thereabouts where a very, very small union, I think less than 2% of our employees, struck over an issue that the other 10 or 11 unions really didn't agree with them that much on. But they struck, and the other unions observed the picket line, which you would expect them to do in a strongly pro-union town such as Buffalo. And I think, as I remember, they struck on a Monday, and I remember leaders of some of the other unions actually with tears in their eyes over this, because they could see it was going to put us out of business. And frankly, I just took the position then. I said, look, if you come back in a day, I know we're competitive. If you come back in a year, I know we will not be competitive. And if you're smart enough to figure out where exactly the point is that you can push us to and still come back and we have a business and you have jobs, I said, you're smarter than I am, so go home and figure it out. And they came back in on Thursday, and we became very competitive again. But they could have, it was out of my hands. I couldn't make them work, and if they decided they were going to stay out long enough, we were not going to have a newspaper. And that's the kind of situation occasionally you find yourself in, and I would say the airline industry is a good example of where people find themselves in that position periodically. Charlie, have any more?
Well, the shareholders may be interested to know, vis-a-vis competitive advantages in our NetJets program, that the day that other charter plane crashed in Aspen, NetJets refused to fly into Aspen at all. People remember that kind of thing.
Yeah. Zone 2.
Good morning, gentlemen. David Winters from Mountain Lakes, New Jersey. Thank you for hosting Woodstock for Capitalists. Berkshire seems to have an enormous long-term advantage in spite of its large size and high equity prices. The structure of the company's activities, non-callable capital, substantial free cash flow, and improving insurance fundamentals permit Berkshire to capitalize on potential asset price declines and dislocations in financial markets, while most investors would not either have the money or the cool minds to buy. Am I on the right track here?
Well, I think in certain ways you are. I mean, we do have disadvantages too. But we have some significant advantages in buying businesses over time. We would be the preferred purchaser, I think, for a reasonable number of private companies and public companies as well. And our check's clear. So we will always have the money. People know that when we make a deal, it will get done, and it will get done as fast as anybody can do it. It won't be subject to any kind of second thoughts or financing difficulties. And we bought, as you know, we bought Johns Manville because the other group had financing difficulties. People know they will get to run their businesses as they've run them before if they care about that, and a lot of people do. Others don't. We have an ownership structure that is probably more stable than any company our size or anywhere near our size in the country, and that's attractive to people. So, and we are under no pressure to do anything dumb. You know, if we do things dumb, it's because we do things dumb, and it's not. But it's not because anybody's making us do it. So, those are significant advantages, and the disadvantage, the biggest disadvantage we have is size. I mean, it is harder to double the market value of a $100 billion company than a $1 billion company using what we have in our arsenal. And that isn't, I hope it isn't going to go away. I mean, I hope we don't become a $1 billion company and enjoy all the benefits of those. And I hope, in fact, we have the agony of becoming, a much larger company. So you are on the right track. Whether we can deliver or not is another question. But we go into combat every day armed with those advantages. Charlie?
Yeah, this is not a hog heaven period for Berkshire. The investment game is getting more and more competitive, and I see no sign that is going to change.
But people will do stupid things in the future. There's no question. I mean, I will guarantee you sometime in the next 20 years that people will do some exceptionally stupid things in equity markets. And then the question is, are we in a position to do something about that when that happens? But we continue to prefer to buy businesses, though. That's what we really enjoy. When Charlie mentioned hog heaven, I thought we ought to open the peanut brittle here, which I recommend heartily. Zone 3.
Good morning. Mo Spence from Waterloo, Nebraska. You've often stated that value and growth are opposite sides of the same coin. Would you care to elaborate on that? And do you prefer a growth company that is selling cheap, or a value company with moderate or better growth prospects?
Well, actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to growth usually is a positive for value, but only when it means that by adding capital now you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year. But whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful, I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case, again, is the airline business. The airline business has been a growth business ever since, that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public. But growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. Charlie?
Well, I think it's fair to say that Berkshire, with a very limited headquarters staff, and that staff pretty old, we are especially partial to laying out large sums of money under circumstances where we won't have to be smart again. In other words, if we buy good businesses run by good people at reasonable prices, there's a good chance that you people will prosper us for many decades without more intelligence at headquarters. And you can say, in a sense, that's growth stock investing.
Yeah, if you'd asked Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business, a growth stock or value stock, who knows what they would have said. But, the real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense. Zone 4.
Hi, my name is Stephen Comp from Irvine, California. I'm 10 years old and this is my 4th consecutive year here.
Terrific. We're glad to have you here.
Thanks. This is my 4th consecutive year here, and how I got to owning stock is my dad taught me to start my own business, and I bought Berkshire Hathaway stock with my profits. And in school, they don't teach you how to make and save money, not in high school or college. So my question is, how would you propose to educate kids in this area?
Well, that's a good question. Sounds to me like sounds to me like you could do a good job yourself too. And I'm, at 10, you're way ahead of me. Unfortunately, I didn't buy my first stock until I was 11, so I got a very slow start. And it's, what it takes really is, and you find it in some classrooms and you don't in others, but it takes teachers who can explain the subject. Charlie would say Ben Franklin was the best teacher of all in that respect, but it looks like you either got it from your parents, an education on that, and parents can do more education really in that respect even than teachers. But it's, I get a chance to talk to students from time to time, and one of the things I tell them is, what a valuable asset they have themselves. I mean, I would pay any bright student probably $50,000 for 10% of his future earnings the rest of his life. So he's a $500,000 asset just standing there. And what you do with that $500,000 asset in terms of developing your mind and your talents is hugely important. The best investment you can make at an early age is in yourself. And it sounds to me like you're doing very well in that respect. I congratulate you on it. I don't have any great sweeping program for doing it throughout the schools, though. We have, here in Nebraska, we have an annual get-together of students from all the high schools throughout the state, and it's a day or two of economic education. I think it's a very good program. But I think if you just keep doing what you're doing, you may be an example to other students. Charlie?
Well, I'd like to interject a word of caution. You sound like somebody who's likely to succeed at what you're trying to do, and that's not always a good idea. If all you succeed in doing in your life is to get early rich from passive holding of little bits of paper, and you get better at only that for all your life, it's a failed life. Life is more than being shrewd at passive wealth accumulation.
I think he's going to do well in both. Zone 5.
My name is Frank Jervich. I'm from London, Ontario. It's great to see all the young people asking questions. I even have my own 11-year-old here, Matthew, this year. I first wanted to start by passing on a message from my wife to you, Mr. Buffett, and that is, thank you, Mr. Buffett, for your autograph that Frank brought back last year. However, quite frankly, the ring in the Borsheim's box you autographed was far more precious.
You can repeat that if you'd like.
My question relates to the future of Berkshire. Back in 1994, there was a PBS video interview of you at the Flagler Business School, and I believe you said Berkshire was not an insurance company. It appears that's not quite the case as much anymore, and I suppose insurance acquisitions will provide the financial fuel and the stability the Johns Manvilles and Mid-America types of acquisitions will need for their future growth. But I'm hoping that you and Charlie can describe for us an anticipated future look at, say, 20 years out of how Berkshire might be different and from how it is today, and perhaps a couple of the not so obvious problems that Berkshire will need to contend with. And thank you for all the apparently wonderful acquisitions you've made on our behalf in the last year.
Well, thank you. I think you ought to take your wife another ring, too. But thank you. We actually, as long ago as, I don't remember whether it was in the 1980 annual report, but at least 20 years ago, we did say that we thought insurance would be our most significant business over time. We had no idea that it would get to be as significant as it is, but we've always felt that was, we would be in many businesses, but that insurance was likely to be our largest business. Right now, it's not our largest business in terms of employment. It's our largest business in terms of revenue, and we would hope it gets a lot bigger over time. We don't have anything in the works that would make that happen, although we will have natural growth in what we already own. But we will just keep acquiring things, and some years we'll make a big acquisition. Some years we'll make a few small acquisitions. We'll do whatever comes down the pike. I mean, if there's a phone call waiting when this meeting is over and it's an interesting acquisition, it'll get done. We don't have a master plan. Charlie and I do not sit around and strategize or talk about the future of various industries or do anything of that sort. It just doesn't happen. We don't have any reports. We don't have any staff. We don't have any of that. We try to look at what comes in. We try to survey the whole financial field. We try to look at what comes in and look for things we understand, where we think they have a durable competitive advantage, where we like the management, and where the price is sensible. And, we had no idea 2 or 3 years ago, that we would be the 87% owner of the largest carpet company, broadloom carpet company in the world. We just don't plan these things. But I would tell you in a general way that 20 or so years from now, we will own a lot more businesses. I would still think it likely, I mean, I think it's certain that insurance will be a bigger business for us in 20 years than it is now, probably much bigger. But I think it's also likely it will be our biggest business still. But that could change. I mean, we could get a deal offered to us tomorrow that, you know, was a $15 or $20 billion deal, and then we've got a lot of money in that industry at that point. So we have no more master plan now than we had back in 1965 when we bought the textile mill, really. I mean, we had a lousy business. I didn't realize it was as lousy as it was when I got into it. And we had to, you know, we just had to start trying to deploy capital in an intelligent way. But we've been deploying capital, you know, since I was 11. And I mean, that's our business, and we enjoy it. And we get opportunities to do it. But the bigger you are, the fewer the opportunities you're likely to get. Charlie?
Well, I think it's almost a sure thing that 20 years from now, there'll be way more strength and value behind each Berkshire share. I also think it is an absolutely sure thing that the annual percentage rate of progress will go way down from what it has been in the past.
No question about it.
Good morning, Mr. Buffett, Mr. Munger. My name is Gary Rotstrom from right here in River City. I've been a shareholder since '93 and have loved every minute of it. Recently, there's been medication available to reduce cholesterol. My doctor even gave it to me since mine is kind of high. Every time I hear what you like to eat, Warren, it makes me wonder what your cholesterol level is. Or if you even worry about it. I think everyone here wants you to be with us for a long time, so have you considered taking this new medication to reduce your cholesterol level?
Yeah, I do know the number, and I don't remember. My doctor tells me it's a little high, but if he says it's a little high, it means it isn't that high. Because he always tries to push me into making a few changes in my life. But I've got a wonderful doctor, and I was lucky last year because I hadn't been in to see him for about 5 years, and due to those guys cost a lot of money. I mean, and due to purely an accident, a reaction to some other medicine I was given when I was out of the city, he got a hold of me, and then he shamed me into having a physical, and it was extremely lucky because I had a polyp in the colon that would have probably caused trouble, you know, within a couple of years. I would say that if you ask my doctor, he would want me to make a few changes, but he would also say that my life expectancy is probably a lot better than the average person of 70. You know, I have no stress whatsoever, zero. You know, I mean, I get to do what I love to do every day, and I'm surrounded by people that are terrific. So that problem in life just doesn't exist for me, you know, and I don't smoke or drink or, well, we'll end it right there. And so, you know, if you were an underwriter for a life company, you would make me considerably better than average. You'd rate Charlie better than average too. And I'm sure that, you know, it could change it slightly, perhaps on the probabilities, you know, if I change my diet dramatically or something. But it's very unlikely to happen. Actually, when my mother got to be 80, you know, the most important thing in life in terms of how long you live is how long your parents live. So I got her an exercise bike when she got to be 80. And she put 40,000 miles on it. And I told her to watch her diet and do all these things. And I mean, she lived to be 92. So, you know, she did her share. And I helped her do it by giving her the exercise bicycle. So I think that improved my odds at that point. Charlie?
Yeah. I have a book recommendation which will be very helpful to all shareholders that worry about Warren's health and longevity. And that's this book called Genome by Matt Ridgely, who was for years the science editor of The Economist magazine. And if Ridgely is right, Warren has a very long life expectancy. There are very interesting correlations between people who cause stress to others instead of suffering it themselves. And Warren has been in that position ever since I've known him. And the figures that Ridley quotes are awesomely interesting. It is a fabulous book, of course. I'm recommending a bestseller, but they're selling it in the airport. It's called Genome, and you'll feel very good about Warren's future if you agree with the science of the book.
Zone 8.
Michael Wang, San Diego, California. First of all, I would like to thank both of you. My question is, when you started your business, why you started an investment partnership instead of a mutual fund? And also, can you recommend a good book or books regarding how to start an investment partnership or fund and how to service clients, etc.?
Yeah, I don't know of any books on starting partnerships or hedge funds. You know, Charlie?
No, but people seem to manage to create them without the books.
Yeah.
The incentives are awesome.
Yeah. And the one thing, I mean, it's always interesting to both of us how you get certain things that are fashionable, and people think that by naming something, a given name, that somehow that makes everybody smarter or able to make money in it. I mean, there is no magic to private equity funds, international investing, hedge funds, all of the baloney that gets promoted in Wall Street. But what happens is that certain things become very promotable, usually because there's been recent successes by other people and that the new entrants extrapolate the successes of a few people in the past to promote new money from people currently. So they adopt titles that, you know, that they think will attract money, and but it doesn't make anybody any smarter if they hang out a shingle in front of their house that says hedge fund, or they hang out a shingle that says asset allocation firm or something of the sort. The form doesn't create talent. I backed into the business. I mean, I'd worked for a mutual fund, closed-end investment company. In fact, there's a fellow here today, a friend of mine, that the two of us worked there, and we were 40% of the whole company because there were three other people, all of whom outranked us considerably. And that firm was Graham Newman Corp. From 1954 to 1956. And it was a regulated investment company. It was about $6 million in assets, which seemed like a big deal at the time. And Ben Graham was one of the best-known investors in the world, and he had $6 million in his fund. There was a sister partnership called Newman and Graham, which operated in what would today be called hedge fund style as far as a partnership split of the profits and so on. And when I left there in 56 and I came back here, we had 7 people, a couple of whom are here in the room, who said, "Do you want to manage money?" And I said, "Well, here's what I learned at Graham Newman, that Newman and Graham is a better way to do it than Graham Newman." So I formed a little partnership. And then I met Charlie a few years later, and he figured if I was making money doing it, he'd make a lot more. So he formed one, and that was the carefully calculated strategy of how we both became involved in the partnership business. Charlie?
Yeah, it is amazing how big the hedge fund industry has become. They have conventions on the subject now. And in the late 20s, you could take a course on how to run a crooked security pool. And these things come in great waves. I'm not suggesting the hedge funds are crooked, but I am suggesting that you get these waves of fashion that go to great extremes. The amount of money, what is it now, Warren, in hedge funds?
It's very big, although it's a little less in a few quarters than it used to be.
Yeah.
But I would be willing to put a lot of money up that if you take the aggregate experience of all hedge funds that as starting right today and going for the next 15 years, I would bet a lot of money it will not hit 10% in terms of return to partners. And if you push me, I would bet at a lower figure than that.
Then you have Bernie Kornfeld's idea, the fund of funds. There are people who want to get paid for selecting hedge funds for other people. And that didn't work very well for Bernie Kornfeld.
Well, it worked pretty well for Bernie for a while, but it didn't work so well for his investors, actually. Yeah. That result was probably something Bernie had in mind at the start, maybe. Zone 6.
Good morning, Mr. Buffett and Mr. Munger. Mr. Buffett, I want to ask you this question last week when I ran into you after Gillette's annual meeting, but I choked. So now there's no pressure. Here goes. In the years from my reading, in the years from 1956 through 69, you achieved the best results of your career quantitatively, 29% annually against only 7% for the Dow. Your approach then was different than now. You looked for lots of undervalued stocks with less attention to competitive advantage or favorable economics and sold them rather quickly. As your capital base grew, you switched your approach to buying undervalued excellent companies with favorable long-term economics. My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses that where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got to, when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities. But, that's such a small world. It may be a way for one person to come up, but it's a long slog.
Yeah, most smart people, unfortunately, in Wall Street figure that they can make a lot more money, a lot easier, just by one way or another, getting an override on other people's money or delivering services in some way that people. And the monetization of hope and greed as a way to make a huge amount of money. And right now it's very, just take hedge funds. I mean, I've had calls from a couple of friends in the last month that don't know anything about investing money. They've been unsuccessful and everything else. And, one of them called me the other day and said, well, I'm forming a small hedge fund, 125 million he was talking about. And, like the thought that since it was only 125 million, maybe we ought to put in 10 million or something of the sort. I mean, if you looked at this fellow's Schedule D on his 1040 for the last 20 years, you'd think he ought to be mowing lawns. But he may get his 125 million. I mean, and it's just astounding to me how willing people are during a bull market just to toss money around because they think it's easy. And of course that's what they felt about internet stocks a few years ago. They'll think about something else next year too. But the biggest money made in Wall Street in recent years has not been made by great performance, but it's been made by great promotion, basically. Charlie, do you have anything?
Well, I would state it even more strongly. I think the current scene is obscene. I think there's too much mania. There's too much chasing after easy money. There's too much misleading sales material about investments. There's too much on the television emphasizing speculation in stocks.
Zone 7.
Steve Casbell from Atlanta. My question concerns Gillette. Do you think their goal of trying to grow earnings at 15+% kind of got them into their current inventory problems at the trade? And as well, the Duracell acquisition, I know at the time neither one of you were the biggest fans of the deal. I just want to know how you feel about it now.
Well, I would say it's a mistake, and I've said it, I think it's a mistake for any company to predict 15% a year growth, but plenty of them do. For one thing, unless the U.S. economy grows at 15% a year, eventually any 15% number catches up with you. It doesn't make sense. Very, very few large companies can compound their earnings at 15%. It isn't going to happen. You can look at the Fortune 500, and if you want to pick 10 names on there that will compound their growth from other than some extraordinarily depressed year. I mean, if they had a year where they just broke even, so the number is practically zero. But if you pick any company on there that currently has record earnings, and you want to pick out 10 of them that over the next 20 years will average 15% or greater, I will bet you that more than half of your list will not make it. So I think it's a mistake, and as I said in the annual report, I think it leads people to stretch on accounting. I think it tends to make them change trade practices, and I'm not singling out Gillette in the least, but I can tell you that if you look at the companies that have done it, you will find plenty of examples of people that have made those sort of mistakes. And I think that in connection with Duracell, I mean, obviously Duracell has not turned out the way that the management of Gillette at the time hoped that it was going to do, and who the investment bankers who came in and made the presentations, those presentations would look pretty silly now. Charlie?
I think that kind of stuff happens all the time. It will continue to happen. It's just built into the system. I see more predictions of future earnings growth at a high rate, not less. I mean, a few people have sort of taken an abstinence pledge, but it's very few. It's what the analysts want to hear.
It's what the investor relations departments want the managements to say. It makes their life easier, but they don't have to be there 5 years from now or 10 years from now doing the same thing. If we predicted 15% from Berkshire, 15% means that, assuming the same multiples, I mean, that means, in 5 years, 200 billion, in 10 years 400 billion, 15 years 800 billion, trillion six in 20 years, and the values get to be crazy. And if you have a business with a market value of 400 or 500 billion, and you had a few of those not so long ago, just think of what it takes to deliver in the way of future cash at a 15% discount rate to justify that. If you've got a business that's delivering you no cash today and it's selling for $500 billion, to give you 15% on your money, it would have to be giving you 75 billion this year. But if it doesn't give you 75 billion this year, it has to be giving you 86.25 billion next year. And if it doesn't do it next year, it has to be giving you almost 100 billion in the third year. Those numbers are staggering. I mean, the implications involved in certain market valuations really, belong in Gulliver's Travels or something. But people take them very seriously. I mean, people were valuing businesses at $500 billion a year or a year and a half ago, and there's just almost no mathematical calculation you can make that would, if you demanded something like 15% on your money, there's almost no mathematical calculation you could make that would could possibly lead you to justify those valuations. Charlie, you have any more?
Well, I said on another occasion that to some extent stocks sell like Rembrandts. They don't sell based on the value that people are going to get from looking at the picture. They sell based on the fact that Rembrandts have gone up in value in the past. And when you get that kind of valuation into stocks, some crazy things can happen. Bonds are way more rational because nobody can believe that a bond paying a fixed rate of modest interest can go to the sky. But with stocks, they behave partly like Rembrandts. And I said, suppose you filled every pension fund in America with nothing but Rembrandts. And of course, Rembrandts would keep going up and up as people bought more and more Rembrandts or pieces of Rembrandts at higher and higher prices. I said, wouldn't that create a hell of a mess after 20 years of buying Rembrandts? And to the extent that stock prices generally become sort of irrational, isn't it sort of like filling half the pension funds with Rembrandts? I think those are good questions.
Once it gets going, though, people have an enormous interest in pushing Rembrandts. I mean, it creates its own constituency. Zone 1.
Mr. Buffett, Mr. Munger, my name is Joe Schulman. I'm a shareholder from Oxford, Maryland. Thank you for a wonderful meeting. In order for Berkshire to have an opportunity to hopefully grow its earnings by about 15% per year, if we can do that, at least for the next few years, it's obvious that because of the redeployment of earnings and float, the existing businesses do not need to grow at 15%. At what rate would you expect the existing businesses to grow to achieve an aggregate rate close to what I'm describing? And what do you think the probability is of achieving that?
Yeah. Well, I think the probability of us achieving 15% growth in earnings over an extended period of years is so close to zero, it's not worth calculating. I mean, we'll do our best, and we have a lot of fun doing it. So it is not something where we have to come down and do things that are boring to us or anything of the sort. I mean, our inclination is to very much to do everything we can legitimately to add to Berkshire's earnings and things we can understand. But it can't happen over time. We will have years when we do it, and you're quite correct in pointing out we don't need to do it from the present businesses. We will add things all the time, any more than we needed to do it from the current business back in 1965 with the textile business. I mean, we have to improvise as we go along, and we will. And the businesses we have are good businesses in aggregate. They will do well. They won't do anything like 15% growth per annum, but we will take a good rate of progress from those businesses, and we will superimpose upon that acquisitions which will add to that. But we can't do 15 over over a period of time. And nor, incidentally, do we think any large company in the United States is likely to do. There will be a couple that do it for a long period of time, but to predict which of the Fortune 500 will end up being the one or two or three would be very hard to do, and it won't be more than a couple out of 500. If you take large companies not working from a deflated base year, I think our method is a pretty good one. I mean, I think the idea of having a group of good businesses that throw off cash in aggregate in a big way, that themselves grow, that are run by terrific people, and then adding on to those, sometimes at a slow rate, but every now and then at a good clip, more businesses of the same kind, and not increasing the outstanding shares. I think that's about as good a business model as you can have for a company our size. But what it produces, we'll have to see. Charlie?
I certainly agree that the chances of this 15% per annum progress extrapolated way forward is virtually impossible. I think generally the shareholding class in America should reduce its expectations a lot.
Including the pension funds.
Yeah, including the pension funds, you bet. It's stupid the way people are extrapolating the past. Not slightly stupid, massively stupid.
And this is a message, incidentally, if you think about it. I mean, nobody has any interest in saying this, a financial interest in saying it, whereas people have all kinds of financial interests in saying just the opposite. I mean, you do not get an information flow if you listen to the financial world or read the financial press. You do not get an information flow that is balanced in any way in terms of looking at the problem, because the money is in believing something different, and money is what it's what causes people to become prominent, or it flows from becoming prominent in the investment world in terms of whether you go on television shows or whether you manage money or trying to attract it through funds or whatever it may be. I don't think if you were an actuarial consultant and you insisted that the companies that you gave your actuarial report to use a 6% investment rate, I don't think you'd have a client. So it's almost impossible for the advisors, in effect, in my view, to be intellectually honest on it. Don't you think so, Charlie?
Yeah, there is a very smart investment advisor in my town, and he said that years ago some risk arbitrage firm would tell his clients, we know how to make 15% per annum year in and year out. And he said, years ago everybody said that's impossible. He says, now in this climate they say, so what? Who's interested in a lousy 15%?
And it was easier in the earlier climate,
yes,
obviously, because the money hadn't been attracted into it.
Generally speaking, there's more felicity to be gained from reducing expectations than in any other way. It is simply crazy for this group to have very high expectations. Moderate expectations will do fine for all of us.
Okay, we'll take one more before we break for lunch. We'll go to number 2.
Hi, Mr. Buffett. My name is Mallory Marshall. I am 11 years old, and I am from Kearney, Nebraska. I have 2 questions. First, my dad would like to know if you have any grandsons my age.
She wants to know if you have any grandsons her age.
How many shares of stock do you have? And I'll tell you the
Also, what investment advice do you have for young people of my generation?
Yeah, well, I've got a grandson fairly close to your age, and he probably would go for a younger woman anyway. So I will mention him to you. Mention you to him. No, if you're interested in financial matters, you've got to have something to work with. I mean, I was fortunate in that respect because my dad paid for my education. If he hadn't, I probably wouldn't have become educated if I had to pay for myself. But so I was able to save $10,000 by the time I was 21, and that was a huge head start. If I hadn't been able to do that, and my first child came along when I was 22, so I mean, the family. It's much easier to save it in those teenage years if you're lucky enough to be in a family where you don't have, where your parents are taking care of your financial obligations. Every dollar then is worth making $10 or $20 later on. And so if you are interested in financial matters, getting a stake early is very useful, and getting knowledge early is very useful. So I would say you're well on the way if at 11 you're even interested in coming to a meeting like this. And I would, if that interest is maintained, I would read financial publications. I would read whatever was of interest to me. I'd be curious about how the businesses around the town of Kearney operated. I would, to the extent that you can get people to talk to you, and people usually like to talk, learn about who's got good businesses in Kearney and why they're good businesses, and learn about the businesses that went out of business and why they went out of business, and just keep accumulating knowledge. That's one of the beauties of the business that Charlie and I are in, is that everything is cumulative. The stuff I learned when I was 20 is useful today. Not necessarily the same way, and not necessarily every day, but it's useful. So you're building a database in your mind that is going to pay off over time. But you have to have a little money to work with. So there's nothing like getting a few dollars ahead, stay away from credit cards, and you can have a lot of fun if your mind goes along that track as you get older. Charlie?
Well, I'm glad to see somebody that has so early shown an interest in getting ahead. There's nothing wrong with getting ahead.
And actually, she may have the best idea about getting ahead by learning the name of my grandson.
Well, there I can give the young lady some advice. Before your feelings totally take over, you should look carefully at both parents and all four grandparents.
Write Charlie and let us know how it works out. Area 6.
And the third question is from my wife. You mentioned earlier if someone were buying a parachute, they wouldn't buy based on lowest bid. We saw you tooling around in a car this week that were to be bought today could probably be bought at a relatively low bid. As someone interested in your health, she's wondering whether you've considered a newer automobile, possibly one with lots of airbags.
Oh, actually, I picked out the car I have based on the fact that it had airbags on both sides. So that was a factor. It may have been the first car of its type ever made with airbags, but I think my car actually, it's both heavy and has airbags, and those are two primary factors in safety. I don't think I don't think a safer car is necessarily being made. It might be safer to drive around in a big heavy-duty truck or something, but I'm not ready for that. Incidentally, on a car, I look at that like anything else. It would take me probably a half a day to go through the exercise of buying a car and reading the owner's manual and all of that. And that's just a half a day I don't want to give up in my life for no benefit. If I could write a check in 30 seconds and be in the same position I'm in now with a newer car, I'd be glad to do it this afternoon. But I don't like to trade away when there's really no benefit to me at all. I'm totally happy with the car. I just don't want to trade away the amount of time I'd have to spend fooling around to get familiar with and get title to and do all the rest of the things, pick one out, so a new car. But if there's a safer car made, I'll be driving in it.
A huge majority of the business school teaching on the field of investment of passive portfolios of securities is not what we believe and not what Warren was taught years ago by Ben Graham. They're just little pockets of our attitude left. There's one at Stanford, Jack McDonald.
Yeah, sure.
And
that's graduate school.
It's graduate school. Yeah. And What's interesting about that is I think it's the most popular course in the whole Stanford Business School. They've got some kind of a bidding system. And yet I asked Jack how he felt, and he said he felt lonely. He's got the most popular course, but in the whole professoriate dealing with investment matters, the Jack McDonalds are a little clan of their own in a side pocket, so to speak. Now they're right, and they can take whatever consolation they get from that. But mostly, if you go to business school, you will learn a lot of things we don't believe.
Yeah, Jack, Bob Kirby comes in and works with Jack sometimes too, and you couldn't. And Bob has got a terrific mind in terms of investment. So that, I mean, there's no question about that. It's not the easiest school in the world to get into, and it is at the graduate level. But there are these occasional little anomalies, as they would say, in the teaching world. I mean, what you really want a course on investing to be is how to value a business. That's what the game is about. I mean, if you don't know how to value a business, you don't know how to value a stock. And if you look at what is being taught, I think you see very little of how to value a business. And the rest of it is playing around maybe with numbers or, Greek symbols or something of the sort. But it doesn't do you any good. I mean, in the end, you have to decide, whether you're going to value a business at $400 million or $600 million or $800 million, and then you compare that with the price. And that's what investing is. And I don't know any other kind of investing, basically to do. And that just isn't taught. And the reason it isn't taught is because there aren't teachers around, who know how to teach it. I mean, they don't know themselves. And since they don't know themselves, they teach something that says nobody knows anything, which is the efficient market theory. And if I didn't know how to do it, and if I ever teach physics, I'm going to come up with a theory that nobody knows anything, because it's the only way I can get through the day. But it's fascinating to me how the really great universities operate in this respect. If you get a sacred writ, I mean, you get in the finance department because you sign on, to whatever the present group thinks. And if they think the world is flat, you better think the world is flat too. And your students better answer that the world's flat when they get on exams. I would say investment finance teaching in this country is in general is kind of pathetic.
Well, I think the business schools do a pretty good job when it comes to accounting, or personnel management, or there are a whole lot of subjects I think they do quite well with. But they miss one enormous opportunity. If you learn to think intelligently about how to invest successfully in businesses, you'll become a much better business manager than you will if you aren't good at understanding what's required for successful investment. So they're missing a huge opportunity to improve the management profession by doing such a lousy job in teaching investment.
Yeah, see, Charlie and I see CEOs all the time who in a sense don't know how to think about the value of businesses they're acquiring, and then so they go out and hire investment bankers, and guess what? The investment banker tells them what to do. Tells them to do it because they get 20x if they do it and X if they don't do it. And guess how the advice comes out? So it's when a manager of a business feels helpless, which he won't say out loud, but inwardly feels helpless in the question of asset allocation, you've got a real problem. And they have not gone to business schools that have given them any real help, I think, in terms of learning how to think about valuation in businesses. And that's one of the reasons that we write and talk about it some, because there's a gap there. Okay, number one.
My name is Martin Mitchell. I'm from Bakersfield, California. My question, two-part question, is concerning debt. We know that individual debt can be devastating. Are you concerned that the American consumer is so far in debt as a whole as to be a problem? And part two is, do you feel that our trade deficit with other countries is of concern to you?
Well, the first question about debt, I think it's very hard to answer about the consumer as a whole. I get letters every day from people who have problems in life, and they revolve. I mean, they're either health or debt, and usually, frequently, the debt is connected with health. But it's been very easy for them to borrow money, and they're in over their heads, and it's all over then. And there's no question that the American consumer is somewhat more indebted in aggregate, but it's a very hard thing, I think, to come into conclusions about whether it poses a serious problem. Most people have had assets, directly or indirectly, that have gained in value enormously, particularly in real estate and some in securities. So there's a greater capacity to carry debt as earning power increases and assets held increases. I can't give you a useful answer in terms of the world as a whole, but I constantly give advice to young people, and those are the only people I talk to aside from our shareholder group. But just don't start out behind the eight ball. I mean, it's crazy to get in debt because it's so hard to get out of debt. And I mean, the idea of having credit card debt, and we issue credit cards in all our businesses, and and so does every other retailer. But the idea of trying to borrow money at 18%, and thinking you're going to get ahead in life, it isn't going to work. And I urge people to use their credit card, but I urge them to pay it off before it starts revolving, because it's too expensive. Charlie and I can't make money with 18% money. I mean, we're looking around for float because we don't want to pay 5% for money. And so I'm very sympathetic to people get in debt, but once you get in it, it is hell to get out. I mean, Charlie will have a few Ben Franklinisms to quote on that subject. In fact, you want to give a few from Ben now? He'd love to, but I let him into it the wrong way.
Good afternoon. I'm Jim Hayes from Alexandria, Virginia. I'd like to thank you and Mr. Justin for bringing his masterpiece into the Berkshire family. But the question arises, will you soon run out of privately held firms that meet the criteria for acquisitions of sufficient size to continue the returns to Berkshire?
Well, that's a good question, because the people that sell to us have the option of private business selling elsewhere or going public. There seem to be enough people that have built businesses lovingly over 50 or 100 years, and their parents before them and grandparents, that really do care about the eventual disposition of them in some way beyond getting the last dollar that day. That we have a supply from time to time of those businesses, and I think we'll continue to see them. You do raise an interesting question: how many businesses like that are worth, $1 billion or more in the whole economy? Well, there seem to be, I wish there were more, but there are enough. So I think we will probably buy, on average, maybe 2 a year, something of that sort. The really big ones, I mean, what we'd love to make is a $10 or $15 billion acquisition, and there would be very few private companies that would be in that category. And then from the ones that are in that category, you have to find somebody that is not going to conduct an auction. We just are not interested in auctions. If somebody wants to auction their business, we're not that excited about getting in with them, because we need people to run it after we buy it, and if that's the way they look at their business, we may get more unpleasant surprises than we've tended to get in the past with the kind of criteria we've used. Charlie?
Yeah, there are two aspects of that situation. One is, are there going to be enough businesses? And two, how much competition are we going to get from other buyers? One thing we do have going for us is that if you are the kind of a business owner that likes the culture that's in this room today, there isn't anybody else like us. Everybody else is off on a different path with a different culture. So, and look at all you. I mean, this culture is popular, at least with a certain group, and surely there'll be other people who like this culture in the future, as in the past, and who will feel right about joining it with their companies.
We haven't had any luck internationally so far, but we would hope that that could change. I was over in Europe about a month ago, and I got asked the question a lot of times about whether we would be a prospect for businesses in Europe, for example. The answer is yes, and then they say, well, you know, why haven't you bought any? And I said, the phone's never rung. I don't know whether they thought that was a brilliant answer or not, but but I left my phone number a lot of places. You know, every time I got a chance, I gave that answer, and maybe the phone will ring. I've got to believe that if we were on the radar screen the same way in Europe over the last 5 years that we have been in the United States, we would have bought a couple of companies. It just, they don't think of us. And a lot of people don't think of us in the United States either, but more do now than did 5 or 10 years ago. And we have actually a reasonable percentage of our acquisitions come directly or indirectly because we've made another acquisition in the past where the seller was happy. It's very hard to find anybody that's been unhappy dealing with us, and they're friends with other people in their industry or whatever it may be. So we hear about things now more often because we actually have what you might call a recruiting force out there of people that have already done business. It's very much like NetJets that way. I mean, we spend a lot of money advertising at Executive Jet, the NetJet service, but still 70% or so of our business comes from owners who are with us. They're by far the best salespeople we have. And incidentally, that's the way I was introduced to the business. Frank Rooney, who's in this room today, told me about his good experience with NetJets back in January or so of 1995, and that's when I joined in. And if Frank hadn't told me, 6 years later, I might not have ever looked into it. I mean, I might have just turned the pages past the ads. But when Frank said, you ought to look into this, I did. Well, that's what we hope we have going for us on the acquisition front, and I think we do to some degree. But we'd like it to be greater, and we'd like it to be more widespread geographically than it is.
When I was a lawyer, I used to say, the best business getter any lawyer has is the work that's already on his desk. And similarly, probably the best business getter that Berkshire Hathaway has is the business practice that's already on our desk. That's what's driving the new businesses in, right, Warren?
Sure.
So it's a very old-fashioned idea. You just do well with what you already have, and more of the same comes in.
Zone 3, please.
My name is Steve Sontheimer. I live in Chicago, and I'm 14 years old. I'm a third-generation shareholder, and my question is, I noticed that you sold our position in Freddie Mac. What risks do you see in that industry?
Are you Joe's granddaughter? Or?
Yeah.
Good. We have an amazing number of second and third and even fourth generation shareholders, which I'm delighted with. I mean, I don't think lots of companies, big companies on the stock exchange are in that position. It is true we sold the Freddie Mac stock last year, and there were certain aspects of the business that we felt less comfortable with as they unfolded, and Fannie Mae too. And we did not. I would stress we did not sell because we were worried about more government regulation of Freddie and Fannie. If anything, just the opposite. So it was not. Wall Street occasionally will react negatively to the prospect of more government regulation. and the stocks will react sometimes short term for that reason. But that was not our reason. We felt the risk profile had changed somewhat. Charlie?
Yeah, but that may be a peculiarity of ours. We are especially prone to get uncomfortable around financial institutions.
We're quite sensitive to risk, in whether it's in banks, insurance companies, or in what they call GSEs here, in the case of Freddie and Fannie. We feel there's so much about a financial institution that you don't know by looking at just figures, that if anything bothers us a little bit, we're never sure whether it's an iceberg situation or not. And that doesn't mean it is an iceberg situation in the least at banks or insurance companies that we pass. But we have seen enough of what happens with financial institutions that push one way or another, that if we get some feeling that that's going on, we just figure we'll never see it until it's too late anyway. So we bid adieu without, and wish them the best, and without any implication that they're doing anything wrong. It's just that we can't be 100% sure of the fact they're doing things that we like. And when we get to that situation, it's different than buying into a company with a product or something, or a retail operation. You can spot troubles usually fairly early in those businesses. You spot troubles in financial institutions late. It's just the nature of the beast.
Really? Yeah, financial institutions tend to make us nervous when they're trying to do well. That sounds paradoxical, but that's the way it is.
Financial institutions don't get in trouble by running out of cash in most cases. Other businesses you can spot that way, but a financial institution can go beyond the point, and we had banks 10 years ago that did that in mass, but they can go beyond the point of solvency even, while they still have plenty of money around. Area 4, please.
I'm Bob Klein from Los Angeles. Wall Street often evaluates the riskiness of a particular security by the volatility of its quarterly or annual results, and likewise evaluates money managers by their volatility, measures their risk by volatility, I should say. And I know you guys don't agree with that approach. I wonder if you could give us some detail about how you come at the concept of risk, how you measure it, just in general, how you approach risk.
Yeah, we regard volatility as a measure of risk to be nuts. And the reason it's used is because the people that are teaching want to talk about risk, and the truth is they don't know how to measure it in business. I mean, that would be part of our course on how to value a business, would also be how risky is the business. And we think about that in terms of every business we buy. And risk with us relates to several possibilities. One is the risk of permanent capital loss, and then the other risk is that just an inadequate return on the kind of capital we put in. It does not relate to volatility at all. Our See's candy business will lose money depends on when Easter falls, but it'll lose money in 2 quarters of the 4 quarters of the year. So it has this huge volatility of earnings within the year. It's one of the least risky businesses I know. You can find all kinds of wonderful businesses that have great volatility in results, but it does not make them bad businesses. And you can find some terrible businesses that are very smooth. I mean, you have a business that did nothing, and its results would not vary from quarter to quarter, right? And so it just doesn't make any sense to translate volatility into risk. And Charlie, you want to add anything on that? Or?
Well, it raises an interesting question, which is, how can a professoriate that is so smart come up with such silly ideas and spread them all over the country? It's a very interesting question. If all of us felt that
Charlie, your dilly bars arrived.
Oh, good.
Yeah. You've heard of getting a second wind.
Oh, fine.
Thank you. You tip him. I didn't think our cracks were that funny.
Right. But I've been waiting for this craziness to pass for several decades now. I do think it's getting dented some, but it's not passing.
If somebody starts talking to you about beta, zip up your pocketbook.
Brian Zhen from China. As a Coke addict myself, I'm excited to report to you, our worldwide promoter-in-chief, that the Cokes in Beijing taste just as wonderful as in Omaha. As an ex-Zen monk, today I feel like visiting the Buddha of the financial world. We have an investment club with a name that ends in .com, believe it or not, which tells you that the frenzy.com friends even seduced Zen monks when we tried to follow you. We find that Mrs. Susan Buffett used to send Zen Buddhism books to her sorority sisters. That's probably why she always has a peaceful smile due to her low expectation of life, which according to Buddha is full of sufferings. But Mr. Munger would tell me that Susan's smile is because you, as the husband, exceeded her low expectations.
That's right.
Yeah. And her father's even lower expectations.
Right.
Anyway, my question is, did Susan also send those Zen books to your office or your bedroom? And if you have read those books, what are the key ideas that contributed to your investment Tao, which even made sense to secluded, narrow-minded Zen monks like me? Thanks for the financial enlightenments you've given us today.
Thank you. I sent those books on to Charlie, so I'll let him answer.
Actually, I tend to be a follower of Confucius. And I think this room is full of Confucian values. If the first law of Confucianism is filial piety, particularly toward elderly males, you can see why I like that system.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Kevin Truitt from Chicago. I have 3 questions for you. Mr. Munger, at last year's shareholder meeting, you stated that you didn't feel that the concept of the cost of capital made true economic sense. Would you explain why you felt this way and what you would do to replace it with anything? My second question is to Mr. Buffett. You've stated the importance of an occasional big idea. How were you able to, in fact, tell when you had a big idea? And my third question, Mr. Buffett, you have talked about the importance of the franchise and sustainable competitive advantage. Companies like Kellogg and Campbell Soup are companies that most people would have said had those qualities. However, over time, those qualities were lost as a result of a change in consumer taste. What gives you confidence that the same things won't happen to Coke or Gillette?
Charlie?
Well,
cost of capital.
Cost of capital first. Obviously, considerations of cost are important in business. And obviously, opportunity costs, which is a doctrine of economics, really a doctrine of lifesmanship, are also very important. And we've always had that kind of basic thinking. Of course, capital isn't free. And of course, you can figure cost of capital when you're borrowing money, or at least you can figure cost of loans. But the theorists had to develop some theory for what equity cost. And there they just went bonkers. They They said if you earned 100% on capital because you had some marvelous business, your cost of capital was 100%. And therefore, you shouldn't look at any opportunity that delivered a lousy 80%. That is the kind of thinking which came out of the capital assets pricing models and so forth that I've always considered inanity. What is Berkshire's cost of capital? We have this damn capital. It just keeps multiplying and multiplying. What is its cost? You have perfectly good old-fashioned doctrines like opportunity cost. You know, at any given time when we consider an investment, we have to compare it to the best alternative investment we have at that time. We had perfectly good old-fashioned ideas that are very basic to use, but they weren't good enough for these modern theorists. So they invented all this ridiculous mathematics, which concluded that the companies that made the most money had the highest costs of capital. Well, all I can say is it's not for us. Now, the other half of that question I leave for Mr. Buffett.
Yeah, what you find, of course, is that the cost of capital is about 0.25% below the return promised by any deal that the CEO wants to do. Very simple. You know, we have three questions on capital with capitals around, and leaving aside whether we want to borrow money, which we generally don't want to do. And one is, does it make it more sense to pay it out to the shareholders than to keep it within the company? The sub-question on that is, if we pay it out, is it better off to do it by repurchases or by a dividend? The test for whether we pay it out in dividends is, can we create more than $1 of value within the company with that dollar than paying it out? And you never know the answer to that, but so far the answer, is judged by results, is yes, we can. And we think that prospectively we can, but that's a hope on our part, and it's justified to some extent by past history, but it's not a certainty. Once we've crossed that threshold, then do we repurchase stock? Well, obviously, if you can buy your stock at a significant discount from conservatively calculated intrinsic value, and you can buy it in reasonable quantity, that's a use for capital. Beyond that, then the question becomes, if you have the capital, you think you can create more than $1, how do you create the most with the least risk? And that gets to business risk. It doesn't get to any calculation of the volatility. I don't know the risk in See's Candy is measured by its stock volatility, because the stock hasn't been outstanding since 1972. Does that mean I can't determine how risky a business See's is because we don't have a daily quote on it? No, I can determine it by looking at the business and the competitive environment in which it operates and so on. So once we cross the threshold of deciding that we can deploy capital so as to create more than $1 of present value for every dollar retained, then it's just a question of doing the most intelligent thing that you can find. And, you know, that is the cost of every deal we do is measured by the second best deal that's around at a given time, including doing more of some of the things we're already in. And I have listened to cost of capital discussions at all kinds of corporate board meetings and everything else, and you know, I've never found anything that made very much sense in it, except for the fact that it's what they learned in business school, and it's what the consultants talked about, and most of the board members would nod their head without knowing what the hell was going on. And that's been my history with the cost of capital. Moving on to the big ideas, you know when you've got a big idea, and I can't tell you, you know, exactly what happens within your nervous system or brain at that time, but we've had a relatively few big ideas, good ideas over the years. I don't know how many you think we've had in aggregate, Holly, in career, maybe 25 each or something.
If you took the top 15 out of Berkshire Hathaway, most of you people wouldn't be here. So roughly one every 2 years.
Yeah, one every year or two. And sometimes there'll be a bunch of them, like in 1973 and 4. But the problem is, for us, is that big now really means big. I mean, it has to be billions of dollars to move the needle very much at Berkshire. But I would say that when I would turn those pages 50 years ago in the Moody's manuals, I would know when I hit a big idea. I've got a half a dozen of them that I keep the Xeroxes from those reports around from 50 years ago, just because it was so obvious that they were incredible. And that happens every now and then. When I met Lorimer Davidson, in end of January 1951, and he spent 4 hours or 5 hours with me explaining GEICO, I knew it was a big idea. 8 months later, or probably 10 months later, I wrote an article to the Commercial and Financial Chronicle on the security I like best. It was a big idea. When I found Western Insurance Securities, I knew it was a big idea. I couldn't put millions of dollars into it, but I didn't have millions, so it didn't make any difference. And we've seen things subsequently, and we'll see. If we have a normal lifespan, we'll see a few more before we get done. But I can't tell you that exactly how. I can't tell you exactly what transpires in my mind that says, flashes a neon sign up that says this is a big idea. What happens with you, Charlie? Actually, I have a real system. My idea of a truly big idea is one I get and I call Charlie and he only says no, rather than that's the worst idea I've ever heard of. But if he just says no, it's a hell of an idea.
The game in our kind of life is being able to recognize a good idea when you rarely get it, and or when it rarely is presented to you. And I think that's something you have to prepare for over a long period. What is the old saying? That opportunity comes to the prepared mind. And I don't think you can teach people in 2 minutes how to have a prepared mind. But that's the game.
Things we learned 40 years ago, though, will help and recognize the next big idea.
And on opportunity cost, going back to that, the current freshman economics text, which is sweeping the country, has right in practically the first page, and it says all intelligent people should think primarily in terms of opportunity cost. And that's obviously correct. But it's very hard to teach business based on opportunity cost. It's much easier to teach the capital assets pricing model, where you can just punch in numbers and out come numbers. And therefore, people teach what is easy to teach instead of what is correct to teach. It reminds me of Einstein's famous saying. He says, everything should be made as simple as possible, but no more simple.
Write that down.
Hi, I'm Dave Staples from Hanover, New Hampshire, and I've got 2 questions for you. First, I'd like to hear your thoughts on selling securities short and what your experience has been recently and over the course of your career.
It's an interesting item to study because it's ruined a lot of people. It is the sort of thing that you can go broke doing. Bob Wilson, there's famous stories about him and Resorts International. He didn't go broke doing. In fact, he's done very well subsequently. But being short something where your loss is unlimited is quite different than being long something that you've already paid for. And it's tempting. You see way more stocks that are dramatically overvalued in your career than you will see stocks that are dramatically undervalued. It's the nature of securities markets to occasionally promote various things to the sky, so that securities will frequently sell for 5 or 10 times what they're worth, and they will very, very seldom sell for 20% or 10% of what they're worth. So therefore, you see these much greater discrepancies between price and value and on the overvaluation side. So you might think it's easier to make money on short selling. And all I can say is it hasn't been for me. I don't think it's been for Charlie. It is a very, very tough business. because of the fact that you face unlimited losses and because of the fact that people that have overvalued stocks, very overvalued stocks, are frequently on some scale between promoter and crook, and that's why they get there. And once they're and they also know how to use that very valuation to bootstrap value into the business, because if you have a stock that's selling at 100 that's worth 10, obviously it's to your interest to go out and issue a whole lot of shares, and if you do that, when you get all through, the value can be 50. In fact, there's a lot of chain letter type stock promotions that are sort of based on the implicit assumption that the management will keep doing that. And if they do it once and build it to 50 by issuing a lot of shares at 100 when it's worth 10, now the value is 50, and people say, well, these guys are so good at that, let's pay 200 for it or 300, and then they can do it again and so on. It's not usually quite that clear in their minds, but that's the basic principle underlying a lot of stock promotions. And if you get caught up in one of those that is successful, you can run out of money before the promoter runs out of ideas. In the end, they almost always work. I mean, I would say that of the things that we have felt like shorting over the years, the batting average is very high in terms of eventual. They would work out very well eventually if you held them through. But it is very painful, and it's in my experience, it's a whole lot easier to make money on the long side. I had one situation, actually an arbitrage situation, when I was when I moved to New York in 1954, so it was about June or July of 1954, that involved a surefire type transaction, an arbitrage transaction that had to work. But there was a technical wrinkle in it, and I was short something, and I felt like for a short period of time, I felt like Fanova was feeling last fall. I mean, it was very unpleasant. You can't make, in my view, you can't make really big money doing it because you can't expose yourself to the loss that would be there if you did do it on a big scale. And Charlie, how about you?
Well, Ben Franklin said if you want to be miserable, during Easter or something like that, he says borrow a lot of money to be repaid at Lent or something to that effect. And similarly, being short something, which keeps going up because somebody is promoting it in a half-crooked way and you keep losing and they call on you for more margin, it just isn't worth it to have that much irritation in your life. It isn't that hard to make money somewhere else with less irritation.
It would never work on a Berkshire scale anyway. I mean, you could never do it for the kind of money that would be necessary to do it with in order to have a real effect on Berkshire's overall value. So it's not something we think about.
Hi, I'm James Halpern from Dallas, Texas, and I've been a shareholder since 1995, and I feel great about it, so thank you. This question has to do with Berkshire's so-called permanent holdings and whether, when making investment decisions, you somehow mathematically calculate a value to Berkshire's reputation for loyalty to its public investees. Let's say you were confident enough that Pepsi or Procter & Gamble would grow cash flow faster than Coke or Gillette would, and that the replacement value of the stock was less expensive enough to more than make up for the taxes. Would you then sell Coke, for example, to buy Pepsi? And if not, why not? And how do you value this reputation for loyalty aspect in those decisions?
Well, I think that's a very good question. I don't think we would ever, I think it's very unlikely we would come to the conclusion that we were that certain that you mentioned P&G and Pepsi versus the ones, but then some major consumer products company would do better than the ones we're in. We might very well decide that some other one is going to do quite well and buy that additionally. As a practical matter, if I'm on the board of the company, or Charlie were to be at representing Berkshire, it's very difficult. I would say it's almost impossible for us to trade in their securities. it creates too many problems. People would think we knew something we didn't, or, particularly if we were selling it, we would have people questioning very much whether we had detected something within the company that was not available to the rest of the world. So we really give up an enormous amount of investment mobility when we go on a board. And so I don't even think about doing what you're suggesting, although I might very well if I were just a money manager running the business. We certainly, and we've laid it out in the ground rules in the back of in our owner's manual back in the annual report, we've certainly said in terms of businesses we buy control of that they just aren't for sale, and a fancy price will not tempt us. And we lay out that exception relating to business where we think there's a permanent loss of cash for as far as the eye can see, or businesses where we have labor troubles, which in the day we might have had at the Buffalo News at that one period. But otherwise, simply because we can use the money better someplace else, we're not interested in it. I can't really dig into my psyche and tell you how much of that is because I think that will help us buy businesses in the future if we behave that way, or how much is just my natural inclination that when I make a deal with somebody and I'm happy with how they behave with me, that I want to stick with them. It's probably both, and I wouldn't want to try and weight the two. I'm happy, with the results of the first, and I'm happy with the way I feel essentially about the second. I just think it's crazy. I know if I owned all of Berkshire myself, I wouldn't dream of trading around businesses with people that have trusted in me and that I like and that have been more than fair with me. I wouldn't dream of trading around businesses so that my estate was 105% of some very large number instead of 100% of some large number. I just would regard that as a crazy way to live. And I don't want the fact I run a public company to cause me to behave in a way that I would be uncomfortable behaving as if we're a private company. But I also feel that you as shareholders are entitled to know that that's an idiosyncrasy of mine, and therefore I lay it out, and I've laid it out for 20 years, as something that you should understand as an investor or before you become an investor. I'm sure it helps us in acquisitions over time, but whether that in any way compensates the opportunity cost that Charlie talks about of making an occasional advantageous disposal, I don't know, and it's something I'll never calculate. Charlie?
Well, I do tend to calculate it at least roughly, and so far I think that the loyalty effect is a plus in our life.
Would you regard that as true, though, in both both marketable securities and owned businesses?
Oh, no, I don't think the loyalty effect in blocks of public companies is nearly as important as it is with the private companies.
You can say it's a mistake for us to be directors of companies because we give up huge amount of flexibility in investment that because we are directors, and there's no question that we do. If you're thinking solely of making money, you do not want to be a director of any company. There's just no question about that.
Tom Harrison from Claremore, Oklahoma. Good afternoon, gentlemen, and thanks for a wonderful weekend. This question is for Mr. Buffett. Being somewhat pessimistic by nature, I have a recurrent nightmare of a Wall Street Journal headline proclaiming Buffett kicks bucket.
They may phrase it a little more elegantly than that, but someday the headline will be there.
And of course, Charlie's no spring chicken either. In light of these concerns, could you please go into a little more detail than that presented in your annual report regarding the secession issue? And my apologies for the morbid nature of the question.
No, there's no reason to apologize. I mean, it's a question I ask our managers, incidentally, every couple of years. About every 2 years, I send them a letter and I say, if you die tonight, what will I wish you'd told me tomorrow morning? And because I have to make that same decision, and I'm not conversing with them every night, so I want them to put in writing to me once every couple of years what they think about the subject, who they think should succeed them, or whether there's several candidates, or what the strengths and weaknesses are, and I have that information available. And you know, you're entitled to the same sort of answer about succession. It's part of buying into this business, and I can tell you that no one has more of an interest in it than I do, and Charlie has a similar interest because we have a very high percentage of our net worth in the business, plus we've got a lifetime of effort in the business, and we want it to succeed for both, in our cases probably, at least in my case, the ultimate reward to the foundation I have, but also because we just want it, we like what's happened so far, and we want to prove that it's not dependent upon a couple of guys like us, but that it can be institutionalized in effect. And we have, and Charlie and I, we know who will succeed me in what are likely to be two jobs, one marketable securities and one business operation. We want to be very sure that the culture is maintained, and I think it's so strong that I think it'd be very hard to change it. But in addition, the stock ownership situation with me is such that it can, if there were any inclination to change it, it can be prevented from happening. I don't think it would anyway. Now, in terms of who succeeds me, that depends when I die. You know, and there's no sense telling you who it would be today. There'd be no plus to that, and it might not be the same 20 years. Now, I mean, 20 years ago it would have been Charlie, obviously, but it won't be Charlie now because of his age, and it'll be somebody else. But 20 years from now or 15 years from now it might be some third party. But we feel very good about the succession situation. We feel very good about the stability of the organization in terms of the stock ownership situation, because that is insured for a very, very long time to come. We couldn't feel better about the managers we have in place and the culture we have in place. And, you know, the individual will be named. I think I've mentioned, though, that when they open that envelope, although the contents of that envelope are already known to the key people, but when they open that envelope, the first instruction is, you know, take my pulse again. I mean, I'm not... But if I flunk that test, there will be somebody very good in place. Charlie?
The main defense, of course, is to have assets that will do well more or less automatically. And we have a lot of those. And to the extent you improve that further by having very good managers in place and very good individualized systems for bringing new managers into the places, there's a lot of momentum here that would go on very nicely with the present management gone. And now, I don't think our successors are going to be as good as Warren at actually allocating the money.
No, we ran a little test case 10 years ago because for 9 months and 4 days, I took another job at Solomon, and things went fine at Berkshire. We've got, the managers don't need me. We have to allocate capital. We have to make sure they're treated fairly, but we are not making decisions around the place except in the allocation of capital, and that will be important. But some of that is semi-automatic, and others, you know, it does require, you know, some imagination sometime or something of the sort. But for 9 months and 4 days in 1991, you know, Solomon was primarily on my mind, and Berkshire wasn't, and everything went on just as before. And we are far, far, far stronger now than we were 10 years ago. So I'm very comfortable with 99% of my estate being in Berkshire shares, and I think it's an intelligent holding eventually for the foundation, and knowing that, you know, I won't be around at some point before the foundation gets it. Okay, area 8.
Good afternoon. My name is Pavel Began. I am from Minsk, Belarus, and I have 2 questions. And before I'll have questions for you, I'd like to say thank you for recommending to read Intelligent Investor. It's a terrific book, and it reshaped me tremendously, literally overnight. So I'd like to thank you for that. And now the question, say I'm an owner of the business, and the business has a durable competitive advantage and superior business model, and is run by able people. And then, I start noticing that basically management starts doing things which are far from intelligent. So what should I do as an owner, as an investor? Should I try to tell them how they should run the business, or should I just sit back and do nothing? Because superior business model should overcome poor management. That's the first question.
On your first question, did you assume that you had control of the business, or you just owned a marketable security?
Yes, if I own, say, 20% of marketable securities.
Well, the situation you described is not hypothetical in the first case. And I would say that the history that Charlie and I have had of persuading decent, intelligent people who we thought were doing unintelligent things to change their course of action has been poor. Would you agree with that, Charlie?
Worse than poor.
Yeah. So I would say that if you really think you're in with people that have got a good business but that are going to keep doing dumb things with your money, you'll probably do better to get out and get in with people who've got a good business and you think they're going to do sensible things with it. I mean, you've got that option. Now, you also have the option of trying to persuade them to change their mind, but it's just very, very difficult. I mean, it is, that's been something we've faced for 50 years. And initially, we faced it from a position where nobody even knew who the hell we were or anything of the sort. But so we've acquired a certain stature over time, perhaps, in talking on the subject, and we've written on the subject, and we still don't get very far. I mean, when people want to do something, they want to do something. And they didn't rise to become the CEO of a company to have some shareholder tell them that their most recent idea is dumb. I mean, that is just not the type that gets to the top. So I would say that as a matter of investment technique, and maybe as a matter of avoiding stress in your life and all of that sort of thing, that and dealing with smaller quantities of stock so it's easier to sell and buy and all of that sort of thing. I would say that it's better to be in with a management you're simpatico with than simply to be in a great business with a management that's bent on doing things that don't make much sense to you. Charlie?
Well, I certainly agree with that.
Second question. I gather is sort of how much does our actual business experience versus book experience help us, or is it?
Well, I'd say, if you look at a person who has just like 2 years of being in the business of investing and versus a person who has been for 10 years in the business of investing, and say the person who has been for 2 years, has read a lot about, Ben Graham's techniques and your techniques and say Peter Lynch techniques. So would you say that the person who has only 2 years of experience may do much better than the second person?
Well, if everything else is equal, I mean, everything else is equal, except the amount of experience you've had. I think the experience is probably useful, but it isn't going to be equal. And I think it's way more important what you've thought about for 2 years than what you've practiced for 10 years. So if there's a divergence in techniques applied, I would rather be with the one that I'm philosophically in sync with. If I'm philosophically in sync with both, and one's had 10 years of experience, the chances are they will know a little bit more about more businesses if they've been around for 10 years looking at them than if they've been around for 2 years. But the biggest thing is that basically they've got their heads screwed on right in the first place in terms of how they value businesses and how they look at stocks, as whether they look at them as pieces of businesses or whether they look at them as little things that move around and that you can tell a lot by looking at charts or listening to strategists on or something of the sort. Charlie and I learned a lot about a lot of businesses over 40 or 50 years. But I would say that in terms of the new things that would come to us, at the end of the second year, we were probably about as good judges of them as we would be today. But I think there's a little plus to having seen more in terms of human behavior and that sort of thing than knowing about the specifics of a given business model. Charlie?
Yeah, I think that I've watched Warren for a long time now, and I would say he's actually getting better as he gets older. Not at golf or many other activities, but
stay with generalities.
As an investor, he's better. Which I think is remarkable. It shows that scale of experience matters.
It helps somewhat to have seen a lot of business situations. I mean, Charlie talks about models, and you construct your models as you go along based on observation. And your models will, if you're paying attention, your models will be somewhat better the more years you spent really observing and not just trying to make everything fit into what you saw the first few years. Area 3.
Hi, my name is Richard Marble from Washington, D.C., and my question has to do with the intrinsic value of Berkshire Hathaway. You've stated several times that you would prefer the stock to be neither overvalued nor undervalued, so that the time people spend owning the security represents a gain from what the security did, the results during that period of time. However, it's a very difficult security to value because of the disparate pieces. And as we saw last year, when you provide a little bit of guidance, in last year's annual report, you said that when the stock price hit $45,000 a share, you considered buying, but thought it was unfair until the annual report came out, so everyone had the same information. And while I also realize that you don't feel there is a particular quote-unquote correct number, would you ever consider giving any guidance in this direction?
Yeah, the answer is we really wouldn't. I mean, to the extent that we were going to repurchase shares, you could certainly interpret that as indicating that we thought it was attractive from the standpoint of remaining shareholders to do so, and we certainly wouldn't be paying over intrinsic value, at least in our judgment, and benefiting the exiting shareholders to the disadvantage of the continuing shareholders. So you might draw that conclusion at that point, but other than that, we would prefer Berkshire shares to fluctuate far less than they do, because we would like ideally, we would like the experience of every investor during the time they held the shares to be exactly proportionate to the progress or lack thereof of the business. And I think we've come over the years reasonably close to that compared to most companies, but the nature of markets is such that reasonably close is probably as good as it's going to get. We don't know the exact intrinsic value of Berkshire, obviously, and if you looked at the figures, if we'd written down secret figures ever since 1965, some of them would look silly now in terms of what has actually transpired. But we try to give you. I think Berkshire is easier to value than most businesses, actually, because we give you all the information that at least is important to us in valuing it. And then the biggest judgment you have to make is how well capital will be deployed in the future. Because it's relatively easy to figure out the present value of most of our businesses. But the question becomes, what do we do with the money as it comes in? And that will have a huge impact on the value 10 years from now. And that will depend a lot on the environment in which we operate over the next 10 years. There'll be a lot of luck in it. I think there's a reasonable chance of good luck, but who knows? It would be a mistake for us to do anything, I mean a big mistake, to ever recommend buying or selling the stock. I mean, how would you tell everybody to do it at once? You'd negate your own advice. You're certainly not going to tell one person, to the advantage or the disadvantage of somebody else. So there's really no way for us to ever talk about whether we think the stock, whether we think it's a buy or a sale, except to the extent, like I say, on repurchases, where there's obviously an implicit judgment being given the shareholders. Charlie?
Yeah. I rather like the way it's worked out. If you average out the period that we've been through, we've come within hailing distance of the objective of having our stock track its intrinsic value. It gets a little ahead sometimes and a little behind other times, but averaged out, it's worked pretty well.
Area 4.
Good afternoon. My name is Martin O'Leary, and I'm from Houston, Texas. My question to you is this. In your annual report this year, in the letter to the shareholders, you indicated that it was 50 years ago that you met Benjamin Graham and that he had a major impact in your life, especially in your investment success. Moreover, you've stated in the past that The Intelligent Investor is by far the greatest book ever written on investing. One of the central tenets in the book was that if you bought a group of stocks, say 10 or 20, that traded at 2/3 or less than net current assets, that you would be assured of a margin of safety coupled with a satisfactory rate of return. Today, if you were to find 10 or 20 stocks that traded at 2/3 of net current assets, would you be inclined to purchase those stocks for your own personal portfolio, not for Berkshire Hathaway? And the second question, since I've mentioned the book, I was wondering which books that you and Mr. Munger have been reading lately and would recommend. Thank you.
Yeah, in respect to your first question, you could probably, if you found a group like that, and you won't, I don't think, you'd probably do all right buying the group. But not because the businesses themselves worked out that well over time, but because there would probably be a reasonable amount of corporate activity in a group like that, either in terms of the management's taking them private or takeovers or that sort of thing. But those sub-working capital stocks are just almost impossible to find now. And if you got into a market where a lot of them existed, you'd probably find wonderful businesses selling a lot cheaper too. And our inclination would be to go with a cheap, wonderful business. I don't think you'll get in a high market or something close to it. I don't think you'll get a lot of sub-working capital stocks anymore. There's just too much money around to promote deals before they really get to that point. But that was a technique. It was 50 years ago. And is Walter Schloss here still? Walter, are you here? Stand up if you're here. I met Walter 50 years ago when I met Ben Graham. And I know Walter's came out this year, but he already knows everything I've been talking about, so he may have left. Walter actually has practiced in securities much closer to the original. He's run a partnership now for 46 years, I guess it is. And he's done it much more with the type of stocks that Ben was talking about in those days. And he has a record that is absolutely sensational. That is far better than people who get promoted and go on television shows and do all of that sort of thing. And he's done it in, what I tend to call cigar butt companies. You get one free puff and that's about it, but they don't cost anything. And that was the sub-working capital type situations. Walter's had to extend that somewhat, but it's been a great record over a considerable, 46 years, a very considerable period of time. So I think if you found that kind of a group and did it as a group operation, and Ben always emphasized a group operation, because when you're dealing with lousy companies, but you expect a certain number to be taken over and all that, you better have a group of them. Whereas if you deal with wonderful companies, you only need a couple. But I think if you see that period again, we'll be very active, but it won't be in those kind of securities. Charlie?
Yeah, and there's another change. In the old days, if the business stopped working, you could take the working capital and stick it in the shareholders' pockets. And nowadays, as you can tell from all the restructuring charges, when things really go to hell in a bucket, somebody else owns a lot of the working capital. The whole culture has changed. If you have a little business in France and you get tired of it, as Marks and Spencer has, the French say, "What the hell do you mean trying to take your capital back from France? They're French workers in this business, and they don't care about, they don't say, it's your working capital, take it back when the business no longer works for you. They say it's our working capital. The whole culture has changed on that one. Not completely, but a lot from Ben Graham's day. There are a lot of reasons why the investment idiosyncrasies of one era don't translate that perfectly into another.
That list that was published, I forget whether it was published in the 1951 edition of Security Analysis or the 49 edition of Intelligent Investor, but there were a list of companies there. There was Sacco Lowell, there was Marshall Wells, there was Cleveland Worsted Mills, there was Foster Wheeler, and all those companies were sub-working capital companies selling at 3 or 4 times earnings. And there was, if you bought a group of stocks like that, you were going to do well. But you certainly don't see that in companies with any size today. And I've seen a few lists of tech companies selling below cash, but they're determined to use that cash, and it may not be there in a year or two. It was a different breed of animal to some extent in Ben's list at that time. Did you ask a second question?
Books you've read.
Oh, books I've read. Well, tell them what books you've read, Charlie.
Well, I mentioned that one book, Genome. I have a hell of a time putting the accent on the first syllable. But that is a marvelous book. And some shareholders send me a book that not many of you will like by Herb Simon, I think, Models of My Life. And it's a very interesting book for a certain academic type. But that Genome, which is the history of a species in 23 chapters, and it's a perfectly amazing book and very interesting.
I may have recommended it before, but if you haven't read Personal History by Katharine Graham, I think you'd find that it's a fascinating story, and more amazing yet, it's an honest story. If I ever write my autobiography, I'm going to look like Arnold Schwarzenegger, but she is compulsively honest about what's happened, and it's really quite a saga.
It is a good book. Yeah. That Janet Lowe book about me, I find, has had a very interesting subchapter, so to speak, in its distribution. I notice a considerable number of people buying that book and sending one copy to each descendant. They believe that if they just do that, the descendants will behave more like the parents. It'll be interesting to see if that works. If it does, it's going to outsell the Bible.
Hold your breath, fella. Area 5.